The missiles stopped. The back-channel negotiations that nobody was supposed to know about produced a document that nobody expected to see signed. Iran, the United States, and Israel reached a ceasefire agreement, and within 48 hours, the financial markets moved in ways that made some traders a great deal of money and left others completely blindsided. The traders who profited were not the ones with the best indicators. They were the ones who understood something specific about how markets price geopolitical risk and what happens to that pricing the moment the risk changes. That is what this is about. To understand what the ceasefire did to markets, you first need to understand what the conflict had already done to them. For months before the agreement, every escalation in the Iran, US, Israel tension was being priced into specific assets in real time. Oil moved on every headline, gold moved on every threat, defense stocks moved on every military development. The market was not reacting emotionally. It was doing exactly what markets are designed to do, pricing in the probability of future outcomes based on available information. When the available information suggested a wider regional conflict was possible, assets that benefit from conflict priced higher, and assets that suffer from instability priced lower. This is the baseline you need to understand before the ceasefire makes any sense. Oil is the first place to look, and it tells the most important story. The Middle East sits on a significant portion of the world's proven oil reserves, and the Strait of Hormuz, the narrow waterway between Iran and Oman, handles roughly 20% of global oil trade on any given day. When tensions between Iran and the United States escalate to the point where military action becomes a realistic possibility, the market immediately prices in the risk that the strait could be disrupted. A disruption of even a few weeks in Strait of Hormuz traffic would create a supply shock large enough to move oil prices significantly higher across global markets. Traders holding long positions in crude oil ahead of the ceasefire had been benefiting from that risk premium sitting in the price. The ceasefire announcement removed that risk premium almost immediately. Within the first trading session after the agreement was confirmed, crude oil prices dropped, not because global demand changed, not because new supply came online suddenly, but because the probability of a supply disruption fell sharply, and markets were priced that probability in real time. Traders who understood this dynamic in advance and had positioned accordingly made money on the short side of oil as the risk premium deflated. Traders who were long oil for fundamental demand reasons and had not factored in the geopolitical component found themselves holding positions that moved against them for reasons that had nothing to do with supply and demand fundamentals. This is one of the most important lessons embedded in any geopolitical market event. Price is always a combination of fundamental value and risk premium. Fundamental value is what the asset is worth based on its actual cash flows, supply, demand, and growth prospects. Risk premium is the extra return investors require to hold an asset given the uncertainty surrounding it. When uncertainty falls, risk premiums compress, and prices adjust to reflect a new lower level of uncertainty. The adjustment can be rapid, and it can feel violent if you are on the wrong side of it. Gold behaved in a pattern that is consistent with its historical role in geopolitical events. In the months leading up to the ceasefire, gold had been elevated, not because inflation expectations had changed dramatically, not because the dollar had weakened enough to explain the move entirely. Gold was carrying a geopolitical premium, an extra layer of demand from investors and institutions that were buying it specifically as insurance against the possibility of a broader regional conflict that could destabilize global financial systems. When the ceasefire was announced, that insurance premium began to deflate. Gold sold off in the immediate aftermath of the announcement as the demand that had been driven by fear rather than fundamentals started to unwind. The sell-off in gold after a ceasefire is counterintuitive to traders who think of gold purely as an inflation hedge. When you understand that gold serves multiple functions simultaneously, as an inflation hedge, as a currency hedge, as a liquidity store, and as a geopolitical insurance instrument, the post-ceasefire sell-off makes complete sense. The insurance demand was real when the risk was real. When the risk reduced, the insurance demand reduced with it. The traders who were long gold for geopolitical reasons had a decision to make quickly. Hold the position and hope the fundamental case for gold remains strong enough to support the price without the geopolitical premium, or exit and redeploy into assets that were going to benefit from the new lower risk environment. Defense stocks tell the third part of the story. Companies that manufacture weapons systems, missile defense technology, surveillance equipment, and military hardware had been performing well during the period of elevated tension. The logic is straightforward. Conflict, or the credible threat of conflict, increases government defense spending. Increased defense spending means larger order books for defense contractors. Larger order books mean higher revenue projections sanctions, and higher stock prices. The market had been pricing in the expectation that defense budgets across the relevant governments would remain elevated or increase further if the conflict escalated. The ceasefire changed that expectation. Defense stocks pulled back after the ceasefire announcement. The pullback was not catastrophic because defense spending does not reverse overnight, and the underlying demand for military technology across the broader global landscape had not disappeared. But the premium that had been built into these stocks based on the specific Iran-US-Israel conflict dynamic began to compress. Traders who had ridden the defense sector higher through the escalation period now faced the same decision gold holders faced. The thesis that drove the position had partially resolved. The question was how much of the original thesis remained valid in the post-ceasefire environment. The equity markets broadly reacted to the ceasefire with relief. Risk appetite increased. Indices in the United States, Europe, and across emerging markets moved higher in the sessions following the announcement. This broad risk-on move reflects a well-documented pattern in financial markets. When a significant source of systemic uncertainty is removed, capital that had been sitting in defensive positions or in cash waiting for clarity begins to redeploy into risk assets. The market does not need the news to be good in an absolute sense. It just needs the uncertainty to reduce. Reduced uncertainty alone is enough to trigger a reallocation toward equities from safe haven assets. Emerging market equities and currencies deserve specific attention in this context because they are often the most sensitive to geopolitical risk in the Middle East. Many emerging market economies are either directly exposed to Middle East energy prices, have significant trade relationships with the countries involved, or carry their own political risk premiums that move in sympathy with broader geopolitical instability. When the Iran-US-Israel ceasefire reduced the overall level of geopolitical risk in the region, emerging market assets that had been discounted for that risk began to recover. The recovery was not uniform. Countries with direct exposure to Middle East trade routes and energy prices moved more than countries with indirect exposure. The currency markets reflected the risk-on shift in a pattern that experienced forex traders would have recognized immediately. The US dollar, which tends to strengthen during periods of global uncertainty because investors treat it as a safe haven currency, gave back some of its geopolitical premium after the ceasefire. Safe haven currencies broadly, including the Swiss franc and the Japanese yen, weakened slightly against risk currencies as the flight to safety demand that had been supporting them began to unwind. Currencies of oil-exporting countries that had benefited from elevated oil prices faced pressure as crude moved lower. The forex market was repricing the entire global risk landscape simultaneously across dozens of currency pairs. The Israeli shekel experienced a notable recovery after the ceasefire. It had been under significant pressure during the period of elevated conflict risk because currency markets price in the direct economic cost of conflict, including infrastructure disruption, reduced foreign investment, capital flight, and the fiscal burden of military spending. When the ceasefire removed or reduced those specific risks for the Israeli economy, the shekel recovered against major currencies. This is a pattern that repeats across any currency that belongs to a country directly involved in a geopolitical conflict. The currency carries the conflict premium on the downside and recovers when the premium deflates. Now, the practical trading dimension. The traders who navigated this event profitably were not operating on luck or superior information about the diplomatic process. They were operating on a framework for thinking about geopolitical events and market positioning that is learnable and applicable across future events of the same type. The framework has several components, and each one is specific enough to apply directly. The first component is identifying the risk premium before the event resolves. In the months before the ceasefire, any trader paying attention to geopolitical developments could observe that oil, gold, and defense stocks were all carrying premiums above what their fundamental valuations alone would support. Identifying this premium does not require a proprietary model. It requires comparing the current price to where the asset would likely trade if the geopolitical risk were removed, and then sizing that gap. The gap is the risk premium. That premium is the trade. The second component is scenario planning rather than prediction. No trader outside the diplomatic process knew when or whether a ceasefire would be reached. The traders who positioned well were not the ones who predicted the ceasefire with certainty. They were the ones who mapped out what would happen to their positions across multiple scenarios and ensured they had a defined response for each one. Scenario 1. Escalation continues. Risk premiums expand further. Long oil and gold positions benefit. Short equity positions benefit. Scenario 2. Ceasefire reached. Risk premiums compress. effects. Short oil and gold positions benefit, long equity positions benefit. Scenario 3. Status quo continues without resolution. Premiums remain stable, no major directional move. Having a position and a plan for each scenario means the outcome, whatever it is, does not catch you unprepared. The third component is speed of execution when the event resolves. Geopolitical risk premium trades move fast because every market participant is watching the same headlines simultaneously. The window between the ceasefire announcement and the initial repricing of oil, gold, and equities was measured in minutes in the most liquid markets. Traders who were already positioned ahead of the announcement benefited from the full move. Traders who tried to enter after the announcement were chasing a move that had already partially completed. This is why the preparation work done before the event is worth more than any reaction to the event itself. The fourth component is distinguishing between the immediate repricing and the secondary effects. The immediate repricing is the fast move in oil, gold, defense stocks, and currencies in the first 24 to 48 hours after the announcement. The secondary effects take longer to materialize and are often more tradable for investors who do not have the infrastructure to compete in the initial repricing window. Secondary effects from the Iran, U.S., Israel ceasefire include the gradual recovery of Middle East regional investment flows, the normalization of shipping insurance premiums in the Persian Gulf, the reconstruction spending in affected areas, and the longer-term repositioning of defense budgets as threat assessments are revised. Reconstruction spending is a secondary effect that created specific opportunities in materials, construction, and infrastructure-related equities. When a region that has experienced prolonged conflict or the credible threat of conflict moves towards stability, the economic activity required to rebuild and develop that region creates demand for cement, steel, construction equipment, engineering services, and project finance. Traders and investors who identified this secondary effect and positioned in the relevant sectors early captured a move that played out over weeks and months rather than hours. Shipping and logistics companies operating in the region represented another secondary opportunity. Elevated conflict risk had increased insurance premiums for vessels transiting the Persian Gulf and had caused some shipping operators to reroute away from the most direct paths through the region. As the ceasefire held and risk assessments were revised downward, shipping costs normalized, and the companies that had been operating under elevated cost structures saw margin improvement. This is the kind of specific operational effect that requires more work to identify but tends to be less crowded than the obvious oil and gold trades. The energy transition dimension adds a layer that was not present in earlier Middle East geopolitical events. The world is in the middle of a structural shift away from fossil fuels toward renewable energy sources, and the pace of that shift is influenced by the price of oil. When oil prices are high because of geopolitical risk premiums, the economic case for renewable energy accelerates because the cost differential between fossil fuels and renewables narrows. When oil prices fall because a risk premium deflates, the competitive pressure on renewables temporarily reduces. Traders watching the clean energy sector around the ceasefire observed this dynamic playing out in solar, wind, and battery storage equities as oil prices moved. The longer-term market implication of a durable ceasefire extends beyond any individual asset class. A sustained reduction in Middle East tension changes the risk calculus for foreign direct investment into the region, for the development of regional trade infrastructure, and for the political stability premium embedded in the sovereign debt of countries directly involved in the conflict. These are not short-term trades. They are multi-year investment themes that begin to price in gradually as the durability of the agreement becomes clearer. The investors who position early in the multi-year themes, while the majority of market participants are still focused on the short-term price moves, are the ones who capture the most significant portion of the total return available from the event. What this entire sequence of market behavior illustrates is something that experienced traders understand deeply, and newer traders often discover too late. The market is a continuous pricing machine that is always trying to estimate the probability of future outcomes and embed those probabilities into current prices. Geopolitical events create opportunities not because they are surprising in the simple sense, but because they force rapid revisions to probability estimates that had been stable for extended periods. The trader who understands how the market was pricing the risk before the event and what the rational repricing looks like after the event has a framework that works across every future geopolitical development, regardless of the specific countries or conflicts involved. The ceasefire between Iran, the United States, and Israel was one specific event. The framework for understanding its market impact is universal. Conflict Conflict risk premiums build into prices during escalation. They deflate during resolution. The assets that carry the largest premiums experience the most significant repricing. The speed of repricing rewards preparation over reaction. The secondary effects reward analytical work over speed. And the long-term implications reward patience and a willingness to hold positions through the noise of the immediate market reaction. Every geopolitical event that moves markets follows this same basic logic. The details change. The structure does not.